I believe the smartest investors are institutional investors. It's patient money. They will often sit on the sideline for years. They'll do a lot of math. They don't jump in easily. And institutional money right now is saying, if I buy a property today, the last thing I want to do is get a fixed rate. Now, if a syndicator is buying a property and he tries to buy it or she tries to buy it with a floating rate, your investors are going to cut your cojones off, right? As far as they're concerned, you're not even a syndicator if you do that. But have you seen what institutional capital is saying? Institutional capital says everything that we buy right now has to be bridge debt.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us the one and only Neal Bawa. Neal is the CEO and founder at UGrow and Grow Capitus, commercial real estate investment companies that use cutting-edge real estate analytics technology to source and acquire or build large commercial properties across the U.S. He has a current portfolio of over 4,800 units with an assets under management value of over $1 billion. Now, you are lucky enough to be listening to part 2 of this episode because there were just so many nuggets jam-packed into his recording that I couldn't fit it all into one episode. So now let's get into part 2 of our interview with Neal Bawa.
So again, the market will start to improve over the next 9 to 12 months, but it's a slow improvement process. I don't think 2025 is a ball-in year for real estate. I think it's a recovery year. Things will get better every month in 2025. I really think it's 2026 and possibly 2027 where you start to see some good trends in real estate. I never think we're going to see what happened in 2021 again. That was a bizarre data point that was tied to a bizarre event called COVID, and we will never see it again.
Yeah, no, I 100% agree with you. It was a total anomaly, which shows everything off, which goes to your earlier point of you need to look at historical data because if you throw the anomaly in there, it's just going to mess everything up.
During an anomaly, numbers don't make sense. And in fact, many high quality people that look at data actually remove anomalous data. Yep. Right? When they're looking at a trend, they remove the anomaly and then the trend makes sense to them.
Right. No, I 100% agree on that. And yeah, it'll be interesting to see because a lot of people think as soon as the Fed flips a switch, then the change happens with inflation. And that's not how it works. It's a lot of these things are lagging and they take time to actually take effect. And that's the inherent danger with what you're talking about with the Fed moving too far, too fast, is that he doesn't give enough time for the markets to adjust to it before instituting another one and adding another weight to your analogy on the chest of the economy.
It's what the Fed does is very difficult. I just want to say this. What they do is incredibly difficult because interest rates take 9 months to impact the economy fully. So once you cut the rate by a certain amount, it takes 9 months for that to wind its way into the economy. So the Fed is very data driven, but is unfortunately forced to always be reading tea leaves because of this 9-month forward curve.
No, and I'll go back to the cliched saying, Warren Buffett says to be greedy when others are fearful and fearful when others are greedy. And I think some of us realize that there's a huge opportunity right now with where multifamily is at. We're just not exactly sure how to capitalize on it. How can multifamily syndicators best take advantage of this current environment?
Talk to your investors. I think the number one thing that you should be doing today is tripling the amount of conversations you're having with investors because they're all speculators right now. They're all scared and you can turn them back into investors. Messaging, messaging, and messaging are the 3 ways in which you can basically take advantage of this. Now, I want to give you one data point to share with your investors. Okay. I believe the smartest investors are institutional investors. It's patient money. They will often sit on the sideline for years. They'll do a lot of math. They don't jump in easily. And institutional money right now is saying, if I buy a property today, the last thing I want to do is get a fixed rate. Now, if a syndicator is buying a property and he tries to buy it or she tries to buy it with a floating rate, your investors are going to cut your cojones off, right? As far as they're concerned, you're not even a syndicator if you do that. But have you seen what institutional capital is saying? Institutional capital says everything that we buy right now has to be bridge debt. Why? Because their belief is that this is the highest interest rates that you're going to get in this environment. Therefore, the risk of rates rising are not zero, right? They're real, but the risk of the chances of rates dropping are far in excess of the chances of rates going up. Just statistically speaking, I'd say there's a 90% chance that in the next 2 years rates will go down, and a very small chance that they will go up from here, right? They might drop and then go up, that those sorts of things happen, but there's going to be a time frame within this time where rates will go down. And as when rates go down, maybe it'll happen 18 months from today, maybe it'll happen 12 months from today, who knows? I don't know. Then that institutional partner wants to basically refinance, not the property, just the loan. They just want to refinance that loan, and maybe they'll go to bridge or maybe they'll go to fixed. They don't, care. So you have to understand that institutional partners are today doing the exact opposite of what every syndicator in America is telling their investors. We're all bragging about our fixed rate loans. We're all bragging about our assumptions, and assumptions are fine. I think assumption is one of those unique things that makes a lot of sense. But if you're getting brand new fixed rate debt on a property, you're doing the exact opposite of what Warren Buffett told you, because you're scared, your investors are scared, so you're putting fixed debt on it. And you're putting fixed debt on it at the peak of a cycle.
Yeah. And so that's the catch 22, right? Because we need to do fixed rate because people will look at us crazy if we try to do bridge debt now. And I think there's always the option to refi down the road with the assumption that rates will be lower in year 2 of a hold if we bought right now, something like that. And because if we tried to do the bridge debt, to your point, like it would be nigh impossible to get investors into a deal, and for good reason based on what's happened. But then it goes back to your point of they're judging based off of the past 24 months versus the bigger picture.
Again, doing the right things is hard to do in both boom times and in depressed times. In boom times, the right thing to do, and institutional investors did it, was to sit by the sidelines and not engage. In a distressed time, and I'm not saying multifamily is distressed, but it's certainly depressed to a certain level if prices have dropped by 22%. The opposite to do is to buy as many as you can and to use floating rate debt. Now, I'm not suggesting that today in August, bridge is the best solution, because bridge rates are very high. They're extremely elevated. And so even if you somehow found investors that would agree, just that the rates don't make sense. My argument is that's going to change in the next 6 months. And even in the next 6 months, people are going to keep buying fixed rate debt because they haven't convinced their investors. But 6 months, 9 months from now, 9 months for sure, bridge debt will make a lot of sense. And I think that most people won't do it because they don't want to tell their investors, this is a bet that we're making, that we're at the top of the cycle. So I think bridge will make its way back in the next 9 months. And I think the biggest reason will be that bridge really needs the Fed to cut by one time, even if it's a single quarter point cut, for bridge debt to become more reasonably priced. So as soon as bridge debt becomes reasonably priced, I'm going to go for it. And if I'm doing a 40-slide presentation for my investors, 15 slides are just going to be about why bridge debt.
Yeah, which will probably be warranted given the skepticism. What I'm seeing right now is this kind of awkward transition period between buyers and sellers. Buyers are like, hey, this is the reality of the market. You need to drop your price by 20%. And sellers are like, but no, because I put this much money into it and it should be valued at this much. And we're like, we don't care. This is reality. You have to accept that. And so there's this tug of war that I've seen happening as we're putting in letters of intent, LOIs, and we're underwriting deals like $1 million, $2 million less than what their starting price is. And it's hard for us to meet in the middle. Are you seeing some of that too?
Sure. And it doesn't bother me at all. So here's my feedback. 2 years ago, if properties were at 3.75 cap and we were $2 million away from the best and final, today Properties are at 5.25 cap. That's 150 basis point different. And that's what the market is bearing right now. Almost every deal that I'm seeing is somewhere between 5 for assumptions, 5.25 if there's no assumption, to 5.5 if it's a 300 unit property. That's the range that I'm seeing in most markets. And today we're $500,000 off or $750,000 off. So our situation has changed radically from 18 months ago, where we were at 3.75 cap and $2 million gap to 5.25 cap and a $750,000 gap. So it's changed in our favor. It's not perfect. There's still a gap between buyers and sellers. But despite that gap existing, keep in mind, we've gone from under 4 cap for the whole market, especially on the value add side, to over 5 cap. So buyers are adjusting for sure. Sellers are adjusting for sure. They just are not adjusting at the same speed that we would like them to make. But isn't it
Yeah,
movement in the positive direction?
yeah, exactly. Yeah, I was about to say, I'm starting to see it shift as well. Hopefully we're at that inflection point, because even on a deal that we put an offer in on, and like I said, we were like 2 million off. So we told the broker, but at the same time, we're like, hey, we just can't make it work for anything that wouldn't insult your seller. But then a couple weeks later, they came back and they're like, hey, they're ready to meet the market. So
Right.
they're ready to accept the reality of their situation. That's probably going to be happening more and more as we go.
It's happening to more and more of them. And so the numbers are becoming more rational. Here's the thing. If anybody expects that for an asset class as privileged as multifamily, and I'll explain why multifamily is privileged more than any other asset class, that gap of 2 million that's down to what I think is 750,000, to think that at any point in the next 12 months, that's going to drop to zero, not going to happen. Again, should I be getting a 26% discount today? Yes. What am I getting? 22. Am I going to take it? Hell yeah. That's really the message that I want to give people, is that there's only two kinds of markets that exist: unbalanced for buyers and still unbalanced for buyers. Those are the two kinds of markets that exist. There's a third kind of market that happens very rarely, and it's called capitulation. And it happened in 2008 and 2009, where the market was completely unbalanced for sellers. That is a very rare occurrence. And despite offices in the United States being down 48%, they still haven't seen a capitulation. Multifamily is only down 22%. So we're very far from capitulation. At capitulation, sellers are like, I just have to sell it for whatever the goddamn it's worth, whatever people will pay me for, not what it's worth, whatever people will pay me for. That's an extremely rare occurrence. I do not expect it to happen at this point in time. And we'll talk about why that isn't supposed to happen. So markets are either unbalanced for buyers or severely unbalanced for buyers. There is no balance. And if you're going to wait for balance forever, you're just not going to buy anything.
Yep. And I know some are in that situation. I think you talked about the multifamily being down, say 22%. I think
Sure.
it's important to put into context for listeners that that is an aggregate, right? Or an average. Whereas you have some markets that are still performing very well, whereas others got hit much harder, say Austin or other markets
Phoenix.
like that.
Yep.
They grew really fast, like way faster than some of their neighbors, but others have maintained.
Yeah, it's an aggregate score. It's also aggregate across different kinds of properties. So Class A properties, for example, have actually been hit harder, which I didn't anticipate. Normally people during bad times run towards Class A properties, but they've actually been hit harder this time around. So that was interesting to watch. So their cap rates have swung a lot, whereas Class B has done fairly well and C's have also swung a fair bit. So B turned out to be the best from a cap rate swing perspective. So that was interesting to me. So there's markets that are down only like 12, 13%. And they shouldn't be, by the way. Those markets are overpriced, but they're performing so they didn't go up as much. So they're not going down as much. And so those markets are beginning to become overvalued, where you have markets that were crazy boom towns like Austin or Phoenix, right? Where prices are now going down by 25, 26, 27%. And large properties in some of those markets are now going down by 28%. When a large 250 units plus, it's a property that's, let's say, on sale today for $40 million, right? 35, 40 million. Almost nobody can raise that kind of equity today. So you're getting an extra quarter or 0.375 bump in your cap rate. And that's a substantial saving for the investors that are buying those properties if you can raise that kind of money. But less and less people are buying those properties. I expect that by the end of this year, a 300 unit property will have dropped more than 30% from its peak, right?
Yeah.
But a 150 unit property might only drop 20%.
Yeah. Still hurts, but it's doable. Yeah.
I think the industry has to adapt. We were the kings of the world, and now we're not. We're just regular Joes.
Yeah. And I think everybody who underwrites talks about being conservative. And I see articles saying, oh, now they can't presume 7% increases or 8% increases. And I was like, yeah, none of us were ever putting that into our underwriting. We may hope for it, but most of the time it was more like 3% rent bumps every year. And part of that whole under promise, over deliver mentality, right? We're going to be conservative in the underwriting, but we're hoping we'll get 20% IAR. We're only going to tell the investors we expect, say 16, whatever. But I don't think there was a whole lot of syndicators, sponsors, whatever you want to call them out there, who were throwing these crazy numbers into their underwriting, just assuming this irrational exuberance would last forever.
I think everyone was irrational to some level. So I think it was 100% of syndicators that were irrational. But no, your point is well made in that they weren't irrational to the level that people are talking about today.
Right.
Point is, when you get good press, you're magical. When you get bad press, everything that you did, good or bad, is bad, right? So you're going to get bad press for the next 6 months as roughly 1,000 properties go back to the bank in the United States. There's 2,500 properties, according to Yardi Matrix, that are bleeding, right? So their DSCR is below 1. And I expect that half or more than half of those would go back to the bank in the next 18 months, and the rest would make it by a very elaborate process of kicking the can down the road to 2025, where dropping cap rates, dropping interest rates, and rising loan to values help some of those properties get sold. Investors would still lose money in those properties that sell in 2025, but they might lose 10 cents on the dollar instead of 50 cents on the dollar or 100 cents on the dollar.
Do you think there's going to be a culling of the field, as it were, for syndicators? And the way I think about that is, hey, everybody wants to be a syndicator when it's easy and everybody's making money. But as soon as you start to have tough conversations with your investors, it gets more challenging to find deals that pencil, and you got to put a little more work into it, and sometimes a lot more work into it. Do you think that field is going to get much smaller over the next year or two?
Absolutely. I opened the conference, the big conference, the best ever conference in Salt Lake City with a session called Crisis Bootcamp: How to Save Your Property with Best Practices of Cash Calls and Rescue Equity. And in that presentation, I said 40% of syndicators in the United States that exist at the beginning of 2023 will be out of business by the time 2025 comes out. So in these 2 years, I expect that will cull basically 40%, 2 out of 5 syndicators. And the biggest reason for them is not what you said. The biggest reason is not going to be that their investors are not going to give them money. Biggest reason is they are not going to make enough money to stay in, because a significant portion of these in the last 2 or 3 years were able to leave full-time jobs or to somehow manage these two activities together because there was so much money, there was so much profit. That profit doesn't exist anymore, right? And it's not going to come for until 2026 or 2027. So a vast majority of these people simply can't stick it out that long.
No, that's a really interesting point that I hadn't really thought of in the grand scheme of things. Obviously, having transitioned into doing real estate full time, I'm living it. The idea that so many people come into this, maybe they started out as a passive investor, whatever the case may be, and they want to go active, and they're going to leave their job as a doctor or a dentist in 2 years and just live as a syndicator. That reality will not exist based on what you're saying compared to what they were able to make the past couple of years.
Absolutely. I think that many of the doctors, the lawyers, and the technologists will go back to their day jobs. And many of the real estate agents will go back to their day jobs. And many of the young folks will go back to their day jobs. So it's there, the culling is by age and also by their ability to make more money in their own respective fields. Those groups are the ones that are going to vanish quickly.
Yeah, that does make a lot of sense, especially with for those who aren't familiar with the compensation aspect of syndicators. There's a chunk up front, the acquisition fee, but most of the big money comes at the end, which could be 3 years, 5 years, 7 years down the road when you exit
It's
properties.
not 3 or 5 anymore. It's 7, right? So the three
It's
or
it's 7 to
five,
10 probably.
yeah, exactly. It's the 3 or 5 what gets wiped out when you're doing using fixed debt. Fixed debt makes no sense at all. People that I know in the industry that are really seasoned, right? They're still buying nothing. I've jumped in, but I'm the first of that batch, of that seasoned batch to say, let me jump back in. I have a friend, his name's Brian Burke. He's been doing this for a while. And he's still, no, I think I'm going to sit out for another 6 months. I'm not in a hurry, right? These are people that are seasoned. They're making tens of millions of dollars from money that properties that they've sold in the last few years. And they're like, chill.
Yeah, no, I understand the sentiment. So I would be remiss, given your background, if I didn't ask you a more tech question. And like a lot of people, I went down the AI rabbit hole when ChatGPT blew up a few months ago. And I know that's a subject that you're very interested in, given your background. I'm curious, have you started using AI in any practical way in your real estate business?
I think the first way which we instantly glommed to was anything in marketing. So our marketing department,
Mm.
basically, we are holding weekly meetings on how did you do things before and how have you changed those things now. Before Chat GPT, after Chat GPT, the world changes. I made a little bit of a joke in my AI presentation. 3,000 people watched, by the way. You can watch it at multifamilyu.com. My mind, artificial intelligence is so unique and so different than any other technology that man has ever known that the date that ChatGPT came out, November 30th, 2022, is almost like BC and AD, before Christ, after Christ. That's how insane the release of ChatGPT is. And this is not obvious at this point in time. If you take the personal computer, the smartphone, and the internet and mix them up together in a bottle and then make that bottle 1,000 times larger, you're looking at artificial intelligence. So because AI uses all of those as ingredients, as free ingredients, AI gets the internet, the smartphone, and the personal computer for free. It also gets cloud computing, which is actually bigger than all of these, as a free enabler. So it basically sits on all of these. And that means that the personal computer, which took a decade and a half to go vertical on its exponential curve, and the smartphone, which took 4 or 5 years to go on vertical, AI can go vertical in a year. So it's the vertical portion of the curve is much more accessible to artificial intelligence. So it changes everything. It changes humanity. It changes everything that we do. It changes every rule that we've created in the last 100 years is going to either change or be utterly destroyed. No other thing that we've ever done will come close to this.
Yeah, and I think people understand that to some extent. It's just with all the press and hype and everything that was coming out, people got overwhelmed at a certain point. They're like, okay, so what do I do with it? Other than telling it to make me a workout routine or give me recipes for something. They don't know how to actively use it. And maybe that'll become more clear as the technology, and maybe it'll be the opposite, right? It'll become so infused in the things that we do in our day-to-day lives that we won't even recognize it as AI. It'll just it'll naturally be in the things that we're doing.
It's a platform technology, right? But I think what people struggle with it is that, are there going to be all these new tools? The answer is sure, there are going to be plenty of new tools, right? I mean, ChatGPT is an example of a new tool. So is Midjourney. But actually, the vast majority of the existing tools that we use, including Zoom and Slack and Outlook and a million other tools, are going to become a lot more intelligent. And that's AI. That's 99% of AI rather than completely new things. And some of those completely new things will be extraordinarily wild and will change our world in ways that are even hard to imagine. So since I can't imagine it, I won't go there. But I think the change that you'll see almost immediately, meaning the next 3 years, is going to be in all of the tools that we currently use. They will become radically intelligent very quickly.
Yeah, I
Right?
think that makes sense. So we do have to transition to the turbo round now.
Sure.
All right. So I'm going to ask you three questions that I ask every guest, and I just ask you for a quick, honest answer. All right. First one. What is one red flag that every investor should look out for?
Um, a syndicator that has fallen in love with the metro and doesn't acknowledge that every metro is both great, good, okay, bad, and horrible, depending upon the point in the cycle.
Okay. What is a myth about this business that you would like to set straight?
That multifamily is great at all points in all points of the cycle. It may be the greatest asset class. It doesn't mean that you should be buying it at all points. That's just Kool-Aid.
Yep. Do your own due diligence. Make sure you know what you're investing in, as should always be the rule. And finally, what does success look like to you?
Having my mind at peace. More than anything else, having my mind at peace is success for me. I think that most people who are rich have their mind less at peace than when they were working a day job. And they may not like that day job and they might like what they're doing now. But if they lost their peace, then what did they gain?
Yeah, I think that's so true. And it's based on evidence, right? There's so much statistical evidence that shows that even people who are considered wealthy aren't necessarily happier. That has to come from somewhere else. All right. Hey, Neal, this has been awesome. I know I had one, a lot of fun, but two, got a lot of value out of the things that we were talking about, a lot of really interesting points. So I know the audience will appreciate it as well. Please tell the listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
If you're watching, behind me is a logo called Multifamily University. If you go to multifamily followed by the letter u.com, multifamilyu.com, we do 12 data-driven webinars each year. Sometimes we'll do 16, and about 25,000 people sign up for these webinars. They're free. They're always meant to be free. There's no upsell. We don't have an educational product that anyone ever gets charged a buck on. It's a community, a bunch of people that get together and talk about interesting stuff. Some of it is multifamily. Some of it doesn't have anything to do with real estate. So join that community, and through that community, several times a year, you'll see projects from us that you might be interested in jumping on. I always tell people, if you want to invest with me right now, don't. Just take your time. You should be taking 9 to 12 months being in an investor's ecosystem before you put money in with them.
Yeah, that makes a lot of sense. And I will attest to the value that those webinars bring because I'm one of those 25,000 people who has been watching them for the past couple of years. So kudos on that. I definitely appreciate all the free educational content that you're putting out there.
Sounds
Um,
good.
all right. Again, we'll have all your information in the show notes, Neal. I appreciate you coming on, and I certainly look forward to continuing to see you do big things on your journey to multifamily millions.
Awesome. Thanks so much for having me on, Tom. Thanks.